Hello and welcome everybody to our annual tax update for SMEs, brought to you live by Tax Nuggets Academy. Let me introduce you to your instructor for today. She is the powerhouse behind the Tax Institute's monthly tax notes from Brown Wrightstein Lawyers, specializing in tax advisory for high net wealth individuals and SMEs. And she's also a former accountant. So please put your emoji hands together to give her a very warm welcome. Hi, Jane Harris.
Hi, Joyce. Thank you. Very exciting to be here with all of you today.
Hello. I know you're not feeling very well, so thank you so much for joining us and trooping on.
I'm always keen to talk tax, Joyce. Like, you cannot stop me.
And it's a massive, massive agenda as we try to cover off what's happened in the entire year.
That's right. How do you cover an entire year in 1 hour? Well, we're going to try and keep it light. We're going to keep it focused on themes. We're going to try and keep it practical. What have we learned this year, really? What are the things that are going to take us into next year? And I'm going to get my crystal ball out and do a little bit of predicting and think about what we might see coming for us in 2026. So I think probably the best thing to do is get into it, yes?
Let's get going.
Do it. All right. Well, I thought I should start off with a retrospective of the biggest decisions that we saw in 2025. So these are the ones that are from very, very high up courts, the High Court, state Supreme Courts, full federal court, things that had big impacts and that are changing the way that tax works. First on the list there, we've got our High Court case in PepsiCo. We discussed that a couple of months ago. That's about the meaning of royalty. And it's interesting because it was the first case on the diverted profits tax, which is an anti-avoidance measure aimed at significant global entities with global turnover of more than $1 billion. So it was an interesting decision in many ways. It told us a little bit about royalties. I also think it's interesting because the ATO has been quite aggressive on the definition of a royalty. And there's been another case just decided this month called Oracle, which is also about that point. It doesn't actually tell us anything yet, but it will turn into a more detailed case, that one. So expect to see more from the ATO about royalties and the meaning of royalty, but that was a big decision this year. We had a case back in, I think it was February, very early in the year, called Naaman and Jaken, which isn't a tax case, but it's about trusts. And what that told us is you need to be careful as a business if you're dealing with a trustee. Because what happened in that case was somebody dealt with a trustee and then the trustee was replaced. So that person they were dealing with stopped being the trustee of the trust. Someone else came in as trustee of the trust. The new trustee got rid of all the trust assets. Our person never got paid. So they sued the person they entered into the contract with, the original trustee, and said, you got to pay me. The original trustee turned to the new trustee and said, all right, I'm entitled to be indemnified out of the assets of the trust. You got to pay me. And the new trustee went, sorry, don't have any assets. So our person who entered into a contract with the trustee lost out. And the ATO, the High Court confirmed there is no duty of the new trustee to cover the old trustee. So I think the person who loses out here is actually the person who entered into the contract with the trustee. So that was a big case, even though it wasn't a tax case. AusNet wasn't a case at all. Strange that it's a big decision if it wasn't a case at all, but the High Court declined to hear anything further about this case. And why that's interesting is this case, the ATO was arguing against itself. The ATO for a long time has been concerned where people use multiple CGT rollovers in a row. And they think that where the CGT rollover has a requirement in it, that what you are getting for your rollover is shares in the new entity and nothing else. The ATO has been concerned that if the plan is you're going to do the rollover, then you're immediately going to do another rollover, then you're not just getting shares in the entity, you're also getting shares in the next step of the plan, which is the second rollover. This case, the ATO actually argued the opposite. The ATO argued that the rollover applied to the taxpayer in this scenario. And I think the reason that this case came up was because the taxpayer realized they actually didn't want the rollover. They would have rather had paid some tax and got a market value in some of their shares. But the ATO was successful, which means they argued against themselves. And the outcome was that the rollover worked, and the fact that there were multiple steps did not mean that the rollover conditions were failed. So where all of that takes us is the ATO is working on guidance about back-to-back rollovers. Now the High Court has said, end of the line, not going to talk about this case anymore. They can go ahead and finalise that guidance. And that's something we're expecting to see next year. So that'll be interesting to see.
So this is really good news. So it sort of shows that back-to-back rollovers
potentially are not
Yep.
the issues the ATO was grappling with. This case suggests they may not be issues. So we'll have to wait and see what the guidance says on that and if there's any cases coming through about that as well. Mm-hmm. So it's a big, interesting non-decision from the High Court.
That's tax for you. You just
That's
need to
tax
know
for ya.
everything, not just tax.
Yep. Toowoomba Regional Council was about FBT and commercial car parks. As an SME advisor, I don't really care about that much because there's an exemption for small and medium businesses. So the commercial car park stuff doesn't come up that much from my clients because they're under the threshold and it just doesn't come up. The reason this case was interesting is a few years ago, the ATO backflipped on its original position and said that car parks that are attached to other things like hospitals and shopping centres are still commercial car parks. Previously, the view was that the point of those was to provide parking for people at the hospital, not to make money from car parking, so it wasn't commercial. ATO changed that view. Federal court said, nah. Original view was right. Those are not commercial car parks. Commercial car parks are ones that are designed to make money from car parking, not that are primarily to provide parking for shoppers or parking for people at the hospital. So that feeds into how FBT has worked out for car parks. But like I said, if your clients are mostly SMEs, probably doesn't come up that often. But ATO was wrong and it got smacked down by the federal court on that.
Yep, that is very sensible.
Then there is the Uber case. That's about payroll tax. It's a New South Wales case, but the payroll tax legislation is mostly harmonised, except you, Western Australia. You don't have employment aid. You don't have relevant contractors, so you don't need to worry about this one. But the rest of Australia cares about this one, even though it's a New South Wales one. It is to do with whether the relevant contractor provisions applied to agreements that had a number of different services under it. And that's really why I care about it. It's very common to have a contract that provides multiple different services. In this case, it was to do with Uber, and the services involved driving people around, providing ratings of the riders, which fed into the algorithm and provided value to Uber, and also referring other drivers. Where all of that is bundled into one agreement, you have to look at whether there is a exception that applies that says that you don't have to pay payroll tax on the payments. And this decision confirmed that if you have one service that one exemption applies to, and then a second service that another exemption applies to, you get no exemptions. The whole thing is subject to payroll. I don't. What? That's how it works. So if you have some services that have no exemption, but some services that do, and it's all in the one contract, you get no exemption. And if you have all your services are covered by some kind of exemption, but they're different exemptions, you still get no exemption. So it's going to change the way we write services contracts to make them much more narrow so that it is one service for each contract so we don't get stuck in this mess. They've applied for special leave to the High Court. I think it's unlikely that special leave will be granted, but we'll have to get the crystal ball out and see what happens with that one.
Yep.
That's my big decisions for the year.
Yep.
Let's look.
For those that just joined us, all the slides, there will be a link in the chat throughout the session.
Excellent. Lessons learned. I cannot cover all of the cases that came out this year in this session, obviously. I actually tried to get my AI to give me a list of all of the cases we covered in our notes, and my AI imploded. It couldn't cope with the document that large. So what I have done is picked out some of the themes we saw coming out of the cases so that we can pull out what are the practical tips that we've learned from what taxpayers brought to tribunals or courts and what the results were. Hopefully it's kind of a useful rundown. We had a few residency cases, and these are to do with individual residents. Now, a while back, the Treasury announced that they were going to change the individual residency test. That went nowhere. Haven't heard anything about that one for a while. It's not even in my crystal ball. It's on the back burner, well and truly. But we can see that residency is still a difficult area to grapple with. And if you've had to advise on it, you'd know it's very fact dependent. There is no real checklist. There's a bunch of different tests, and we see that borne out in the cases that have come forward. Mostly the cases said it's very hard to break your connection with Australia. If your domicile is in Australia, that is when you were born, your father had a domicile here, sexist test, or if you have moved to Australia, set up citizenship and made yourself an Australian resident, it's quite hard to break that connection and go elsewhere. That's very, very difficult. So the Evans case was a FIFO worker. They were stuck in Botswana because of COVID regulations, but their family was here, their home was here. I think if you asked them if you're going home for Christmas, they absolutely would have said they'd be in Australia. So the tribunal said they're still a resident. They haven't broken that connection. Let's jump to the bottom. Key is on appeal. Talk about that in the coming up section. That one, again, the court and the tribunals both have found that he hasn't broken his connection with Australia, even though he was outside of Australia for most of the income year in most of the relevant years. They still said his connections, because he had family here, were still in Australia. The exception to that was this Abotomey case. He was a bit of a weird one, I have to say. The reasoning was a bit odd. I find it hard to reconcile some of the things that it said. It is very fact dependent, but in one of the years, this person was able to break the connection with Australia, even though his spouse and family stayed in Melbourne while he was working in Shanghai. So you can just see it's very fact dependent. Maybe it's worth having a crack. Maybe it's worth getting a ruling if you're in a difficult spot. All right, work-related expenses, a perennial favourite and a constant issue for tax agents on the ground. We've had a number of people trying to claim things with mixed amounts of success. CBRX was a tribunal decision about a FIFO worker. Unfortunately for the FIFO worker, the question is, when do you start work? Because we need to know when your expenses are at work and when your expenses relate to travelling from home to work. And because it was FIFO, they had to travel a very long distance. And in fact, because it was during COVID, they had to stay in Darwin in a hotel and quarantine for 2 weeks before they could get out to Broome or the Pilbara, which is where they were working. Kimberley, where they were working. Unfortunately for them, they didn't clock on until they reached their mine site, which means that all of the travel from their house to Darwin, the hotel, all of that is travelling from home to work. It's a very long trip. It's still travelling from home to work. It's still private, and you can't claim a deduction for that. The fact that they worked from their laptop in their hotel room, which is something clients love to bring up with us, but I worked while I was on holiday. I checked my emails. Therefore, my holiday is deductible. Doesn't get you there on the nexus. Paul is a big and interesting one. That was the sports presenter who claimed his home office occupancy costs, so his rent, a portion of his rent, for the time that he was working from the spare bedroom during COVID. The tribunal allowed those deductions, and it goes against all of the policy that we've seen previously, all of the rulings that we've got on this topic, and arguably against some of the High Court decisions on this that have previously been set out. So the ATO, unsurprisingly, is appealing. They've also issued a decision impact statement saying we're ignoring this. We're not going to deal with this until the appeal is heard. So
it is interesting, this one. Yeah.
Yeah, it's a really interesting one. I'll talk more in the what's coming up section about why I think it's so significant. And then there was Shaw, the long haul truck driver. He claimed $30,000 in meal expenses. If you pop that in the tax return, you can imagine that's going to set up a red flag with the ATO. So the ATO did, in fact, audit him and queried whether he was able to claim the meal expenses. This was a funny one because when asked about it, he said, well, I don't have to have receipts for all of it because I have claimed the reasonable amounts for food and drink according to the tax office's own ruling. And the tax office went, yeah, but 30,000? That's a lot. No, we don't think that's right. And the tribunal kind of went, guys, you said what is reasonable. He has claimed what is reasonable. Therefore, the substantiation exception applies. What are you talking about? So the tribunal allowed his expenses. I believe that the ATO might be appealing this one as well. So if you've got people on travel allowances, just remember, it has to be a kind of expense that is covered by the allowance, and you also have to prove that they incurred the cost. So you don't have to prove every receipt, but you do have to prove they actually incurred the costs. So if you are a long-haul truck driver and you do the main you do the same route and you always stay at the same roadhouse and you always get the camel burger, then maybe a diary that shows that that's what you did and then something that shows that you did that many trips per year would be enough to substantiate that that's a cost that you've incurred, rather than having to have a receipt every time.
Yeah. So actual outgoings and, bank statements and stuff would help.
It
I
helps.
assume.
Yeah.
Yeah.
Yeah. So that was our work-related
wins
expense.
for taxpayers.
Yeah, some good wins on the work-related expense front. Not so much for these guys. This is our unexplained deposits crew.
Oh, the income side of things.
The income side of things. And the ATO has been pretty active on this. We had a number of childcare centre cases this year. I think they were doing a bit of a blitz on the childcare industry. And they certainly found some low-hanging fruit in terms of people with not very good records to pick off. So when I say unexplained deposits, what the ATO does, they've got two methods of issuing default assessments on these things. One is they can look at your lifestyle, because you know what? The ATO sees what your salary is. And they can also see boat registries, car registries, property transfers from the various state land registry offices. And they can see pretty quickly, if you're buying a bunch of luxury cars and you're on a pretty small salary, they'll go, do you perhaps have another source of income that you haven't told us about? So that's what we call an asset betterment assessment, where the ATO says, you've got a lot of assets. We're going to assume that the cost of those assets was funded by income. You have to prove otherwise. The other option is to do an unexplained deposits analysis, where they basically go through the bank account and say, we don't know what any of these items are, so we assume they're income. You have to prove otherwise. And the ATO can get a bit aggressive on those. I've had some where the ATO has assessed tax refunds as income, where they've assessed Medicare rebates as income, because they've just literally taken the income line out of the bank statement and been like, all of that's income. The problem is, once you're in that position, you have to prove otherwise. And it's not enough to say, well, that line item is not income and that line item is not income. You have to prove every dollar of your income. And for all of the cases on the screen, they did not have the records to be able to substantiate every single item and prove whether what it was and why it was not income, which means they lose and the assessment stands. So it's a very harsh regime if you're stuck in it, and poor records are going to let you down.
That's where bookkeeping comes in. Good bookkeepers.
Good bookkeepers.
Shout out.
Receipts on the zero file, on the miles file.
Drag and drop. Or,
Drag and drop.
Receipt
Yep,
bank
indeed.
or whatever.
Loan agreements. Or if not loan agreement, email at the time saying, hi, did you receive the money that I just loaned you? Or happy birthday, I just sent you a gift. That kind of thing can help. And yes, I saw a question just popped up. Did the ATO look at all kinds of bank accounts? Yes, they have access to all the kinds of bank accounts, and they will take them all into account. Claiming deductions. So we've looked at the income side. We have now looking at the deduction side. Mixed success again. So the first one was a property group where there was an operating company that was owned by two people, and then there was a asset owning entity that held the IP and the employees and was paid services, paid service fees. And that asset owning entity was actually owned by a number of investors who were expecting to get a return. So I think that's really important in this case. They had an agreement for the service fees, and they didn't follow it. The amount they paid didn't actually resemble what was in the service agreement. But what they did do was sit down at the end of each year, and they had a process that they followed to say what would be a reasonable amount for a service fee to be paid based on the amount of employee services provided, the amount of profits made by the business. They sat down, they worked it out, they did that consistently every year, and that's how they determined the fee. And so the ATO said, no, we're not accepting that that is a genuine fee in relation to your business, so you haven't incurred that amount, so you cannot claim a deduction for it. And the court disagreed. The court said, I know they haven't followed the written agreement, but they have a process, and it's clearly connected to the use of the assets in the business, and you've got investors who are expecting a return. This is all entirely commercial. This is not some dodgy profit-shifting thing. Yes, you can have your deductions. We contrast that to the South Seas holding case, where there was a bunch of interest and management fees being paid. When I say interest and management fees, that's a little bit loose. They had a system too, and their system involved sitting down at the end of the year and working out how much profit this company has and how much losses that company has, and moving that equal amount into the loss company so that nobody pays any tax. So some years they paid large amounts. Some years they paid no amounts. The interest was similar. Sometimes they paid a huge dollop of income back, or a huge dollop of money back to the lender. Sometimes they paid nothing back to the lender. There was nothing resembling a loan agreement nor an interest rate involved. And the ATO and the tribunal agreed, said, no, you haven't incurred a genuine expense here. You're just making up numbers. Making up numbers and putting through journal entries, that doesn't get you there. So, bit of a contrast there, but I think you can see the difference. Someone just asked, would that be Part 4A? You don't need Part 4A. Part 4A only comes in if the thing that you did worked. You actually incurred an expense that you could claim a deduction for, then they could say it's tax avoidance. But in this case, they said you didn't incur an expense, so you don't get the deduction. We don't need Part 4A, you just don't get a deduction. Easy.
I think we might need to move a little bit quicker, Jane. We're almost at the halfway mark, but probably a third into
no
the
worries.
slides.
We've got some cases here about directors who got into trouble with DPNs. All of them had great arguments for, I shouldn't be responsible for this. I was a special purpose director. I relied on others to tell me that everything was okay. I took steps 2 years after I got the DPN to try and put the company in liquidation. And then there was the wife who got appointed as a director and had no idea what was going on in the business. That one's unfortunate, but all of the cases result in the director being liable. So DPNs are scary. Anyone who's going on a company as a director really needs to take them into account. There are very limited defences and they're very hard to get up on. Mm-hmm. So all of these cases, the taxpayers lost and were subject to the director penalty notices.
Yep. Ignorance is not bliss in this case.
Ignorance is not bliss. And if you get a director penalty notice, I know they look scary, but you got to jump on that. Mm-hmm. You cannot say, I will wait till my manager gets back from holidays. You got to move on that because you may only have 21 days to do something about it. And it's 21 days from the date of the letter, not 21 days from when you get it. So, yeah, scary. Input tax credits. We've got a number of people who fell afoul of the 4-year time limit. You have 4 years from the end of the period the end of the first period in which the input tax credit could be claimed. You have 4 years to claim it. Once that 4 years is over, that 4 years is over. No more credits for you. Tax liability is still there, so you have to pay GST. Commissioner can still recover that, but you get no credits. And all of these people said, but, it's unfair, but I had circumstances, and the tribunals just said, I get that, but there's no discretion. It's 4 years, and then it's over. So they all fell down on that one.
Right, there's no ability to object or anything? Okay.
Not on the 4 years. If you get your objection in before the 4-year time limit expires and you say I'm entitled to this many credits, then you might be okay. Yep. But once the 4 years have expired, you don't get your credits, you lost them. So it's a really important one. It's important in property development mainly is the way I see it come up, where you might not get an invoice until more than 4 years after the first. Yeah, anyway.
Okay.
And then trust issues. I won't spend long on this case, but it was a question about trust distributions, and the tribunal looked at the data around when the trust distribution resolutions were created and found that the trust distribution resolutions for what was supposed to happen before 30 June were all created the next year when the tax return was being prepared, not before 30 June. So there was no evidence that the trust distribution had been made, and the result was that in this case, the default beneficiaries were assessed, not the intended beneficiaries, which meant that instead of paying 10% withholding tax, they paid 47% tax on quite a large number.
This is the first and only case that I've heard about trust resolutions.
Yep, that's why I put it in the roundup for this year. They specifically looked at the evidence that the decision had been made, and they found there was not enough evidence, and that caused the distribution to fail for tax purposes, and therefore default beneficiary got assessed.
Yep. We got a case now. Yeah.
We got a case. R&D, there's a bunch of people who've fallen afoul of R&D. There was a promoter penalties case. There was Ultimate Vision. See our October update if you want to know about that one. And there was the ATO. You can see they've been on a blitz on R&D. They were misbehaving a little bit in the R and Clarke case. That's also, again, in our October update if you want to know more about that one. Bit of a wild story. R&D, I just want to say, It generally comes down to the evidence. Do you have evidence of the R&D work? Does it meet the requirements of core R&D activities? And can you tie the time that was spent to the actual projects that were core R&D activities? It is not sufficient to have half-assed documents, generic timesheets. I worked from 9 till 5. That is not sufficient, and clients are generally unaware of getting those. You guys as tax agents, for those of you that are, you have obligations under the Code of Professional Conduct to ensure that the statements that you are making or assisting to be made to the ATO are true or correct, or at least not misleading in any particular. So if you are relying on an R&D consultant to assist with that, which I do recommend because they know what's happening probably better than you if you don't work in the R&D space, but read their report. Don't just staple it to the back of the tax return. Read the report, check the numbers. If you know this business only turns over $1 million and they've claimed $10 million in R&D, extra questions, and also ask the consultant who's looked at the records, because sometimes the consultants don't get into the timesheets. They're more focused on, are the activities R&D? And somebody needs to be asking, do you have the timesheets to back this up if the ATO comes knocking? So those are my big R&D lessons from the cases that we've seen this year.
Yeah, and ultimately it's the tax agent that's signing off the tax return, not the R&D consultant.
Correct. So if you're including that, you don't have to be in all the detail, but you need to have asked reasonable questions and just sense checked it a little bit. Which brings me to the Novel Arguments Awards. I chucked these in here because one of the things I love about talking tax cases with people is the stories that we get. And so some of my favourites from this year I just popped in here. We had a case called Tetron and Linrod earlier in the year. There was a trust case, and the family members said that the person bringing the case did not have standing because he wasn't a beneficiary of a trust because he wasn't the son of dad. No, he's not our brother. Dad's not even the real father. So the case started with a DNA test. He was. He was there. He did have standing.
So much drama.
But yes, who says tax cases are boring? So that's definitely in there for the soap opera. This is from the Mangini case, which was from last month. Someone, again, trying to claim input tax credits outside the 4-year limit. He was an Uber driver, and Uber drivers have to register for GST regardless of turnover because it's classed as a taxi service. And so he said that he was compelled to participate in GST because of Uber. Uber made him do it, held a gun to his head and put him under duress and made him sign up for GST. So his contract with Uber and therefore the commissioner is void. I haven't signed my contract with the commissioner. Have you signed your contract with the commissioner? I don't remember doing that. And then when that didn't work, he said the ATO doesn't exist. The deputy commissioner was not validly appointed. The terms taxpayer and income are not properly defined. That I could probably pay. I don't think they're in the definition section, so that one possibly. And I must have missed this announcement, but the Prime Minister is being indicted for war crimes, and therefore David doesn't have to pay GST.
Right. Self-represented, did you say?
Self-represented, yeah. How did he guess? Yeah. So Novel Arguments, get an award. Well done. We also had a few people with some interesting input tax credit claims. There was Anthony. Anthony registered a non-resident unincorporated association that was Anthony. Not Anthony, but Anthony. And then he immediately claimed $30 million in input tax credits. And the ATO is onto this. They did not give him $30 million. They did stop that at the border, but they also penalised him $28 million. So I think he just bankrupted himself. Good job.
Quickest way to bankrupt yourself.
The penalty is what you claimed, not what you got paid. So bad luck for Anthony Evans. And then there was Brian, who registered the GST based on an enterprise. You have to be carrying on an enterprise. And his enterprise was running for political office, flipping a house, and my personal favourite, investing plans, didn't actually, but planning to invest in gene technology to bring people back from the dead. There you go. You didn't think you had zombies on your bingo card for the tax update, but there you go. Unsuccessful, was not an enterprise.
Certainly very entrepreneurial.
Yes, entrepreneurial, but still not an enterprise.
Not an enterprise for GST purposes.
All right, some cases to watch for 2026. We've mentioned a couple of these. Bendel, everyone's very excited about Bendel. I'm not sure it's going to make that much difference. Controversial opinion. My reason for that is that there are other things the ATO can use, Section 100A or Subdivision EA, that will still result in someone being taxed on these amounts under Division 7A or 100A. So we'll see what happens with the High Court with Bendel. We expect that early to mid next year. Hall, we talked about previously, the guy who claimed his COVID occupancy expenses. My concern with that one is if it stands, and I mean, it was a win for him because he got to claim his rent. For everyone who's got main residence, though, if it turns out that your spare bedroom is a place of business, then that can put a dent in your main residence exemption for CGT. So I'm not sure we all want to win this one.
Yeah, true,
right?
true.
Hall one, I don't think we all want to win. I think actually we're rather happier having our spare bedroom not be a place of business that could trigger a dent in the main residence exemption. Morton was a property development case. It went against the ATO. ATO lost. ATO is appealing. It was a large-scale subdivision of land, but the farmer who owned it previously wasn't very involved in the development, and it was found to still be on capital account, despite it being hundreds and hundreds and hundreds of lots. Key, going back for a fifth time, been through the tribunal, appeal tribunal, federal court, back to tribunal, going back to federal court again. Whew. Can't wait to see what happens with that one. That's a individual residency case. The merchant case, the High Court just granted special leave, so another High Court case. That is about Part 4A and a sale of shares to a super fund in order to generate a capital loss that then offset a large capital gain. Both parties are appealing. Merchant is appealing because he doesn't want Part 4A applied to him, and the ATO is appealing based on the way the dominant purpose test was applied. So it'll be an interesting Part 4A case. Tax nerds, very exciting. And then Uber, like I said, special leave's been applied for, but I don't think it's likely. There was a full bench of 5 judges on the Supreme Court decision for the Uber case. And I think part of that was, and so many senior counsel involved, the list of counsel was enormous. So I suspect that was all aimed at making it as robust a decision as possible. And historically, the High Court has not considered payroll tax to be of sufficient public interest to run a case. But it still hasn't been determined yet. So we could see it, potentially an Uber High Court case. Have to wait and see. All right. Running through some of the legislation that's happened, there haven't been a whole lot. The instant asset write-off just passed, hallelujah, to 30 June 2026. We don't have that 30 June, what do we put in our tax return this year again? It's sorted until 30 June 2026 at least. It's keeping it the same as it was the previous year, $20,000 instant asset write-off. So that's good news, I think. They're continuing to suspend the 5-year lockout rule as well. So that means you can dip in and out of simplified depreciation without having to wait 5 years before dipping back in again. So again, a good thing, makes it easier for small businesses. Payday Super, very big news. That one has now passed. The legislation is in, so it is official. It's coming in from 1 July 2026. Time to get ready. There's a number of changes to how it's going to operate. Instead of ordinary time earnings and salary and wages, we will have a new concept called qualifying earnings. And your pay the super will have to be paid to the employee's fund, so it has to be received by the fund within 7 business days of payday. So lots of software upgrades, I think, expected for that. On that note, Small Business Clearinghouse is closing. It's already closed to new users from 1 October, and it retires officially on 1 July. So everyone's got to get their STP software happening, and your small clients, there's not a lot of wiggle room. So you're going to have to get a solution in place for them. Stuff that's coming. Announced measures. Div 296, this is the super tax on balances over 3 million, or now they've added an extra bit for balances between 3 million and 10 million. We've been talking about this for ages, and then they've gone and flipped the script and changed it entirely, what they're going to say. So now it will be 30% tax on earnings on super balances over 3 million, and then 40% tax on earnings on super balances over 10 million. They will both be indexed, which is a good thing because that wasn't there before. Everyone's pleased about that, I think. And it only applies to future realised earnings. We don't know what that means yet. All we've got is an announcement. We haven't got any legislation yet, so we have to wait and see.
Future realised earnings.
Yeah. So what does that do for maybe they'll do something like when transfer balance cap was introduced. Remember, we all had to do the calculation of unrealized capital gains up till that point and do a step-up calc. I remember doing that. I remember writing software to do that for share management software. Fun times. Maybe they'll have something like that. It doesn't sound simple, does it? I don't know what it's going to do, but it doesn't sound simple. But we'll have to wait and see how the details are going to shake out. But at the moment, that's coming for next year. We'll have to see how that happens.
1 July 26. Yep.
Correct.
Okay. Mm-hmm.
Potential changes to DIP 855. This was announced in the budget. It was a consultation paper in June 2024. Why am I talking about it now? Because just last month, the Deputy Commissioner said, I expect that we're getting improved certainty on this. So maybe he knows something I don't know. So this is to do with when non-residents sell shares or indirect interests in property, whether that property is a taxable Australian property or not. So if it's shares, is it shares in a company or a trust that has interests in Australian property? It's currently a point-in-time test. They're going to expand it to over the last 12 months. Again, we only have a consultation paper. We don't have legislation, but maybe coming up.
Mm-hmm.
This one got dropped this week. Senate committee inquiry into the operation of the capital gains tax discount. Now, this is the exact terms of reference off the website. This is not my words. So this is what they're saying that they're going to look into. Looks a little bit leading to me. Seems like they've already reached some conclusions in the way that they've framed the questions, but it's currently open for consultation and the committee will present a report in March next year. So we could see some changes to CGT discounts. That would be a big change.
It's like tax reform-y stuff.
Yes, it's actual tax reform-y.
Just talking about it though.
My instinct is they're not likely to change something right before an election, but have to wait and see.
Cool. Another report.
Mm-hmm. The ATO has given us some public guidance this year. There are a couple of things on Division 7A. If you want to dive into those, I do recommend going back to our comprehensive updates because we've got diagrams with little flying bits of money going around the screen that shows how lots of arrows, lots of little pictures. But the ATO is looking at and feels the need to provide guidance on arrangements with interposed entities where you've got a private company trying to provide funds to a shareholder or associate, where providing it directly would be Division 7A. So there's another entity somewhere in the mix, usually one that doesn't have distributable surplus, so that the company goes to the other company, the company without distributable surplus on loans to the person. Because there's no distributable surplus, your deemed dividend is nil. There are specific anti-avoidance measures in Division 7A, that's 109R, 109T, 109U, that relate to that. The ATO has introduced tax determinations that explain a little bit more about how that operates and also where they're focusing their attention on trying to catch people out on that. Payday Super, we just were talking about. The ATO has released a draft practical compliance guideline just in the last week or so about how they're going to approach compliance in the first year. So if you've got clients who are worried about that, or if you want to read up on how it's likely to roll out between now and 1 July, probably worth having a look at that guidance. And all of these ones on the screen there, I've linked for you. So if you've got the slides, you can just click on that. It'll take you straight to the guidance.
Just a quick plug. We had a webinar yesterday, 1.5 hours on all the new changes as well as that draft guidance.
Fantastic. There's been some rulings on ThinCap and the third-party debt test, something I try and stay out of. I do a little bit of. It's generally larger entities that have debt deductions of $2 million or more. The rules all changed for ThinCap on 1 July 2023, and the debt deduction creation rules were introduced from 1 July 2024. They are completely new rules. If you haven't done ThinCap for a few years and you're like, oh, I remember I used to do some ThinCap, forget it. Rules are completely changed. We've got new guidance for you. Go check it out. Software royalties currently in draft, pending Pepsi. Well, Pepsi's been decided now, pending this Oracle decision potentially. How the ATO decides to finalise that, we'll have to wait and see. And then there was some guidance on capital raising to fund franked dividends, where a company wants to pay dividends to its shareholders that are franked because its shareholders love franking offsets, but doesn't have cash. So instead it goes to the market, issues new shares, uses the share subscription money to pay the dividend. It's like a little bit of a Ponzi scheme. The Treasury has changed the law, and now the ATO has provided guidance. If you do that, then the part of your dividend that is funded by this capital raising you don't get your franking credits on. So it's to stop people doing schemes to pay out large franked dividends that they can't actually back up based off their assets.
Yeah. Shouldn't we only pay dividends when you're profitable and got cash?
Yeah, you should. You should.
Usually,
Usually, yeah. There's also been some guidance on market value, on valuations for ESS interest, so employee share scheme interest under the startup concessions. We love the startup concessions for ESS. It's usually the best outcome for everyone involved. There are some rules about when you can use these concessional valuation methods. They are different to the eligibility rules for the startup concessions themselves. So just because you are eligible for the startup concessions does not necessarily mean you are eligible to use these concessional valuations. So this instrument that I've linked here, it's new, but it's remaking a previous instrument, and there's been no changes in how it works. But if you are dealing with startups, do not just assume that you can use net tangible assets or a director's val. You might need to get an independent valuation in order to apply the ESS rules correctly. All right, crystal ball, what are we looking at? What's coming down the road? Well, yesterday, the ATO withdrew a old IT ruling about rental deductions. And I thought, that's funny. Why are they withdrawing that one? And they say it's been replaced with TR 2025/D1. I went, oh, did I miss that? And I looked it up. And as of right before this webinar, it's not currently out yet, TR 2025/D1. So they've withdrawn the old one. New one, I expect, will be released probably later today, or at least this week. So that's very, very near future. Keep an eye out for that one. There's a draft PCG on personal services, businesses, and Part 4A. We expect that to be finalised also this month. Don't know whether there'll be any changes. It's been there for consultation. We'll have to see what the compendium says when it comes out. And then the ATO has also announced these two other tax determination and then two PCGs in relation to these other matters. Don't know what they're about, but they're expecting it by the end of the year. So Christmas presents from the ATO.
They love giving out shock Christmas presents.
They love dropping rollover. They love dropping rulings right at Christmas time. It's just okay. We mentioned back-to-back rollovers earlier in the session. We'll have to, now that AusNet's been satisfied, we'll have to see what they say in their guidance on that. Deceased estates, there is an issue when somebody dies and then their beneficiary dies before the first estate has been administered properly. It causes problems for the CGT exemptions that normally apply for deceased estates. This is a known issue. We talked about it in some detail in our comprehensive session last month, October. But the ATO is about to release guidance. The guidance we understand is just going to confirm, yeah, this is a problem. You could lose your CGT concessions as a result of this double death issue. So that'll be an interesting one to look at. Okay.
Oh, breathe. It's just like drinking from a fire hose, Jade.
I know. I've got all the up there. Well, you've got all the up. You got a whole year of tax.
Yes.
The ATO has finalized vulnerability framework. This is for vulnerable taxpayers. Highly recommend taking a look at that. We've had some recent success with GIC remissions and things like that, where we've had taxpayers who are vulnerable, noting to the ATO that they've made these commitments to deal with compassion with people and to deal with them in a particular way. And we've actually had some success in getting more favourable decisions as a result of this. So it's already helping the vulnerability framework. The ATO also has said that it's going to do better with its complaint resolutions. To wait and see. Your mileage may vary on that, but have to wait and see. The ATO's focus areas, I think, for SMEs and privately owned groups are not a surprise. They've been saying this for a long time. I feel like they update it on a regular basis and it says the same thing. Mm-hmm. These are the key hot areas the ATO is looking at. Debt collection, I don't think there's a tax agent out there that will dispute that one. There's definitely been a big uptick in debt collection activity over the last 18 months, 2 years. Division 7A, we can see from the guidance they've been publishing, that's a continuing issue. Succession planning and family trust distribution tax, I'll talk slightly more about on the next slide. And then for small businesses, using business money that's not yours, constantly a problem. A lot of taxpayers don't really understand their structures. They think the money in the company is their money, and it causes all kinds of problems. Non-commercial loss rules, we're seeing the ATO seek to apply those a lot more. I've had a number of disputes this year where they've talked about non-commercial loss rules. So those are the ones that quarantine your losses from your side hustle, so it can't be used against your other income from other sources until you make profits from said side hustle. Small business CGT concessions, those things are complicated. And I can attest to the Tax Nuggets is doing a seminar series at the moment on small business concessions. So if you're working on that, need to get up to speed or possibly get some advice on applying them, because they are very complex and there's a lot of pitfalls and people are mucking them up on a regular basis. And then anything that's still under the table, the cash economy stuff, that's still a focus area for the tax office. So succession planning, the ATO is looking particularly at intergenerational transfers of wealth, looking at how people are getting rid of their DIP 7A loans. Are they paying them out? What are they doing to get those off the balance sheet? They're looking at pre-CGT status of assets. Got to think about things like CGT event K6, Division 149. Those can jump in where you've got a pre-CGT asset and you can end up with tax, even though the asset has been owned since before 1985. So there's a number of things the ATO is looking at specifically in that handover of wealth between generations area. And then a really big one for me is the family trust distribution tax. The ATO has been very vocal on this lately. And the things that they've said is, if you've got a trust that's made a family trust election, they have picked a person and made a promise that they will only distribute to that person or people who are in their family or their family group of entities. That definition has some quirks and the class can be a bit narrower than you might otherwise think. It's a nasty one because as soon as you break that promise and you make a distribution or you make a payment or you make a loan interest-free or you make some other kind of availability of asset to that person, then family trust distribution tax applies automatically. No need for the ATO to assess it. It just happens. And general interest charge starts accruing from the date that you made that payment. What that has resulted in is some private groups having GIC liabilities for payments that were made in the 90s, and now the GIC exceeds the payment in the first place. And the ATO is saying we can't remit that. We have no discretion not to collect that. And they are bankrupting family groups over this. So family trust elections is a huge area of focus. A lot of ATO investigations at the moment are bringing up, do you have a family trust election? Either do you need a family trust election? If you are passing through frank distributions or utilising losses, you may need one. Or if you do have one, who of those distributions, payments, interest-free loans being made to, and are they outside the family group? So I'm particularly concerned about interest-free loans from trusts to entities because the definition of when an entity is in the family group, pretty narrow. So area to watch for 2026.
There's no time limit on FTDT, Jane?
There is no time limit.
Cool.
No amendment period. Unlimited. Excuse me. All right. ATO has also given us a list of the industries that they're targeting. Top of the list. Lucky you.
Oh.
And lucky me.
Yep.
Tax advisors and professional firms. Property and construction industry. They have cash issues. They have GST issues. People who are flipping houses and claiming main residence exemption or small business concessions or, all that CGT stuff when actually they've made a revenue gain. That's in the sites. Private equity is an area that they're looking into. Retail, that's more your GST, your point of sale, recording devices, warranty payments, things like that. There's more. Cross-border transactions, those things are complicated anyway. So it's not a surprise the ATO is scrutinising that, especially with the new with the new thin capitalisation and debt deduction creation rules coming in. Related party financing overseas, both under those and also under transfer pricing, is something the ATO is looking at. Crypto. Lots of people being very entrepreneurial with their crypto. The ATO can data match that. I know it's supposed to be untraceable, but the ATO is well and truly onto it. So there's no escaping from declaring those gains in your tax return. Misuse of SMSFs. I've got about 4 SMSF rectification matters on for me personally at the moment, and there are some doozies of people doing things with SMSFs where they should not be doing with SMSFs. So it's not a surprise to me the ATO is looking at this. Retirement villages and GST refund fraud. So people doing genuinely shady things to get ineligible and applying for GST refunds, or registering companies that aren't theirs, claiming the refund and putting it in their own bank account. So real fraudy stuff.
I still can't believe that, tax advisors are first on the list.
I know, right? This is why the tax ombudsman, we're going to talk about tax ombudsman, just released a report about the phone line. And one of the things she said was that the ATO should apologize to tax agents and say what a good job they're doing. So, Tax Practitioners Board, we've had a lot of changes on Tax Practitioners Board and Tax Agent Services Act over the last little while. Sorry to say, there's more coming. So we'll hear more from the TPB next year. The first part is really strengthening the sanctions, so that won't affect you on the day-to-day. And then the second part is to do with the registration framework. They'll be changing how registration occurs. Hopefully these are beneficial things, like they'll make things easier, but also we expect the TPB to be looking more at formal documentation of your governance and your quality assurance procedures and conflict management procedures within practices. So I think more paperwork. Tax Ombudsman's doing a number of reviews, so we'll have to see what the reports come out for that. I'm particularly interested in the GIC remission. One, because I know it's been very, very difficult to get GIC remissions lately, so it'll be interesting to see what recommendations the Ombudsman has on that front. And then lastly, there's a number of reforms coming in from 1 July 2026, and I was just chatting with Joyce before about getting up to speed on these. This is going to impact on accountants, lawyers. It's going to impact our practice a lot, financial advisors, and it's going to result in more paperwork, and that means more costs for clients. So it's worth getting across these changes, and it's worth having conversations early with your clients about how the costs for things like incorporating a company or being the registered office for your client's company could be more expensive in the future, and it might be worth having that chat up front so that they are prepared. But expect to see more CPD from, I think, all the providers, your industry professional bodies, possibly tax nuggets. There'll be people out there talking about this because it's big and there's probably some changes that need to happen in how you run your practice. Okay. Do we feel updated? Do we feel like we've done a year's worth of tax in 50 minutes?
I'm very torn, Jay. That was your last slide, yeah?
Yeah, that's my last slide.
I'm very torn. I'm just like, oh my God, so depressed because like, oh my God, there's so much to learn and to do and to prepare for next year. But at the same time, wow, amazing opportunities, so much work to do and, grow our revenue, etc. But I'll let that sink in. But quick plug for Brown Wrightstein's monthly tax updates notes. Did you know that they give it away for free? And in my opinion, they are the best tax notes in the industry for SME and private clients. So link is in the chat. Click, and please subscribe. They will email it to you every month. We are almost at the end. A few Q&As before we do our little giveaway. So, first question is about the Naaman and Jaken case, about the replacement trustee. Mm-hmm. Does this mean that a replacement trustee company, rather than just directors, should be considered?
I don't think it makes much difference whether it's individuals or a company, although the company has the benefit of being limited liability, so the humans behind it won't have their personal assets at risk. So that's usually the consideration in being a trustee in the first place. Normally, a trustee is entitled to be indemnified out of the assets of the fund, the trust. The risk is if the trust no longer has assets, then you're personally liable as the trustee and there's nothing to fund your indemnity, so you're just personally liable. So that's why we would normally use a company as opposed to using individuals if there's that kind of risk.
Yeah, but this case really highlights, it's better to have a company, Amazing.
Well, it's better to have a company if you're the trustee. It's not better to have a company if you're dealing with the trustee.
Yeah. Depends on which side you're on. Question from Vicky about the asset betterment test. That's a new term I learned today, by the way. Asset betterment methodology is how the ATO, go and finds extra revenue. Does a photo of your winnings at the casino count as substantiation for the asset betterment test?
Casinos are interesting. So the amount of data that is available about what you did at a casino is immense. They can see when you walked in, they can see which table you sat at for how long, and they can tell They can get reports from the casino. So people, that's usually where people they have losses at the casino or they have winnings at the casino, and they're like, that's where I got the money. So the ATO has ways of checking that and probably has more info than you about that. So potentially, but I back the ATO's information gathering on that ahead of yours.
And no AI generating these sort of images, by the way. It will need to be substantiated for real. Thank you so much, everybody, for your time today. Hope you really enjoyed this massive update. And we hope to see you at our next live event. Please put your emoji hands one last time to say thank you to Jane. Cheers, everybody.